So it's a post-trade session evaluation for the Friday trading session. Price action, we took a trade and stopped out at break even. However, trade outcome looked really, really nice. Now we took two trading opportunities today, or we actually took one trading opportunity and one that we missed because we got home late and was unable to enter the market because I wasn't on the charts. And that is something I want to address to myself as well, because missing opportunities because you're not at the chart should not really be an excuse, especially if I'm trading a 4-point checklist. If we understand requirements, then we should already understand and anticipate what price action should do at given areas. Therefore, either limit orders or being present on the charts to regularly check in on price action on your mobile phone will actually be a pretty good option. I actually used to do this before, but then I got too obsessed with it. That's why I took it away, but it's all part of the learning process. Now, I particularly want to focus on this trade that I have taken today. Now, my trading outcome of this trade was a break-even trade position because I put stops to break-even risk off of the table when price action came down to my first rejection area. It's typical of how I manage my position. Why this is interesting to me is because I could potentially change my trading model. However, it does mean I'm taking away a big factor that I've always relied on in the past, which is taking away my risk off flexibility. So if we look here, this on my 4-point checklist is identifying a specific range within the environment I am currently in. So in order for me to understand and determine where price action is in this range means I need some form of confirmation that price action is actually respecting this as a range. So I couldn't just take the first retest that price has given me, especially after this 5-minute candle closed you with a bearish wick or a bearish candle with no bottom wick. So I can't take this as a wick entry to then start trading the range below because I haven't been given any form of proof that tells me price action is respecting this as an area of resistance. So price action and then fall down. What I utilized was my range 2 breakout on the lower time frames. So we look on the 5, you printed a range. If you look on the 1 minute, it's even more clear that price action has printed you the range in between these areas. You're looking for price action coming down. You're looking at advantage point here. Price action pushes up. You're looking at validation. Price action pushes down, validates your area. We determine the stop loss to break even risk area, the advantage point, based off of my 4-point checklist because we understand what price is mirroring matters. Now, price action pushing up typically from the zones of 398 will push you down. Start rejecting at around these areas. So I did have a little bit of a uncertainty of whether these wicks will be grabbed and swept. My stop loss was literally just above these highs. Price action comes down to your first rejection area, which was absolutely spot on. But what I didn't think about was time frame alignment on the 30-minute and the 1 hour, because the 30-minute at that given time didn't have a closure. So as we got risk-free moved stop loss to break even on this trade, price action came up to wick you out to then push you back down. So the question I was asking myself is, how can I still make this position pay if I took the same entry? I'm not forcing myself to take the same entry, but it was one that made sense to me. If I know, utilizing the 4-point checklist, that technically, even though this isn't your most optimal entry point, price action is still technically valid to push all the way up towards your resistance to wick you out again at 4.8, retest this area before pushing down. This is still a validated trade. Everything with this price action is still validated because you're respecting the resistance, you're respecting the range that you're currently in, 349 to 330 to 323. So this entire range is still being respected. Can I not use risk off and keep it where I'm accepting the fact that I've peaked 100 pips in profits, price action just to come back into drawdown to then give you all the orders that you needed on the 30 top wick for price action to push down? This is incredibly risky on my end because from the way I've been taught, from the way I've learnt, I understand that taking risk off the table is the best way to preserve portfolio and preserve the progression in trades because you know it's tapped your advantage. Price action's already giving you signals that it's not quite ready to drive down just yet. Why would I want to willingly push a trade that's already 100 pips in profit back into drawdown to potentially lose? That's where I'm coming from. This is the way I've learned. However, I'm interested in what other traders will do because if you look at logical price action, technically this trade is still validated. Do I want to keep the same trade entry, let price come back into drawdown, willingly accept that price action may wick you out in your stop loss before coming down again or going up the other way? Or do I play it safe and keep doing this but miss the opportunity and try and identify this range again? That's the question I want to ask myself. The way I want to develop this is to make sure that that is the key question I want to learn out of this trade because after all, I came out with a break even. This trade would have been a winning trade of 199 pips. This was a really, really good quality session. I saw the advantage. I utilized range 2 because I didn't want to get in on a wick entry and gamble on the fact because the 5 minute has already given me indication of lack of range to the downside. So once we had the confirmation of resistance, we identified the ranges, we followed the 4 point checklist, we utilized the range 2 retest model as an entry point, and unfortunately for me, I got wicked out at a break even, or price action flew all the way down to 199 pips of profit. You get days like this as a trader, and also it helps me with optimizing, with adapting my skill sets. It's not something I'm looking to change straight away. Obviously, we need to see a lot more data being gathered before looking at changing certain things in a skill set. So my main question for myself is, could I look to adapt if we have a range 2 retest and we're still validated within the range, if I'm willing to risk another set of drawdown to potentially stop you out after peaking an X amount of profit, is it worth the risk? Otherwise, risk-free works just fine. The analysis was fine, the levels was respected, and I'm happy with today's outcome. I will go over this trade again with the trade entry, with back testing, and the other week's performance within the Sunday recap. This was a very predominantly focused trade recap on this trade execution, which turned out to be a break-even trade, what could have been a 199 pip win.